Most traders would have held this trade for buy-side liquidity, and that's exactly where they got trapped. After sweeping major and minor inducement, price reacted from demand and created a bullish imbalance. The FVG entry looked perfect. The market delivered 1 to 3, and everything seemed to be going according to plan. But then something happened that completely changed the outcome of this trade. Before looking for any entry, I noticed 2 inducement levels resting below price. First, the market swept the minor inducement, which often convinces traders that the liquidity grab is complete. But price wasn't finished yet. It continued lower and eventually swept the major inducement as well, reaching the demand zone. That second sweep was the key event, because it allowed smart money to collect deeper liquidity before showing any meaningful bullish reaction. Once both inducement levels had been cleared and price started respecting demand, I began looking for confirmation that buyers were stepping back into the market. After sweeping the major inducement, price entered the demand zone and immediately started showing strength. Instead of continuing lower, buyers stepped in aggressively and rejected the discount area. This reaction was important because it confirmed that the demand zone was still being respected by the market. At this stage, I wasn't looking for an entry yet. I wanted to see whether this reaction could create enough momentum to shift price away from the demand zone and reveal smart money's intentions. From the demand zone, price didn't just bounce, it displaced aggressively to the upside. This strong bullish expansion showed that buyers had gained control and that the liquidity sweep below had likely served its purpose. The displacement was important because it created imbalance in the market and gave me the first real clue that price might continue higher from this area. This is where I started preparing for a potential continuation setup. As price displaced away from the demand zone, it left behind a fair value gap. This imbalance was important because it represented inefficient price delivery and a potential area for retracement. Rather than chasing the bullish move, I marked the FVG and waited patiently. If the market was truly bullish, I expected price to return into this imbalance, find support, and then continue higher. That FVG became the key area I was watching for a low-risk entry opportunity. Eventually, price retraced back into the fair value gap, exactly as I anticipated. Instead of entering impulsively during the displacement, I waited for price to return to my area of interest. As the retracement respected the imbalance and showed signs of continuation, I executed my buy entry. This gave me a much cleaner risk-to-reward profile, with my stop-loss protected below the structure and enough room for price to expand toward the upside. With the entry secured, the next step was identifying where price was most likely to draw toward. Above the current market structure, buy-side liquidity was resting, making it a natural objective for bullish price delivery. As long as buyers remained in control, there was a strong possibility that price would continue pushing higher into that liquidity pool. However, instead of relying on BSL alone, I followed my trade plan and focused on a predefined 1 to 3 risk-to-reward target. That way, the trade remained rule-based rather than dependent on expectations. After respecting the fair value gap, price started moving exactly as expected. Buyers remained in control, and the market continued delivering higher. As the move developed, my predefined 1 to 3 risk-to-reward target was eventually reached, allowing me to secure profits according to my plan. At this point, the trade had already done its job. Many traders would start thinking about holding for more, especially with buy-side liquidity still resting above. But for me, the objective wasn't to predict every tick of the market. It was to execute my plan consistently and protect the profits the market had already provided. With the 1 to 3 target already achieved, the next area on my chart was the buy-side liquidity resting above the highs. Naturally, many traders would expect price to continue pushing upward and eventually take that liquidity. And to be fair, that was still a possibility. However, I wasn't relying on the market to reach BSL. My focus was on executing the setup according to plan. Even though the liquidity remained above price, I had already secured my profits at 1 to 3. Now the question was simple. Would the market continue toward BSL, or was something else about to happen? Instead of continuing toward buy-side liquidity, the market started showing signs of weakness. The bullish momentum that pushed price into my 1 to 3 target was no longer present, and buyers began losing control. As sellers stepped back into the market, price gradually reversed direction and moved lower. This reversal caught many traders off guard because the liquidity above remained untouched. What looked like a strong bullish continuation ultimately became a reminder that the market doesn't always deliver to every liquidity target immediately. This trade teaches a lesson that many traders learn the hard way. Before entering this position, I already knew where my target was. My plan was simple: manage risk properly and secure a 1 to 3 risk-to-reward outcome. When price reached that target, the trade had already achieved its purpose. However, this is where most traders make a mistake. They see buy-side liquidity resting above the highs and immediately start expecting more. Instead of following their plan, they start following their emotions. The first mistake is greed, wanting more after the target has already been reached. The second mistake is changing the plan mid-trade, turning a 1 to 3 setup into a BSL target simply because price looks bullish. The third mistake is judging the trade by what happened afterward. Just because the market reversed later doesn't mean the setup failed. A professional trader measures success by execution, not by hindsight. My target was 1 to 3. The market delivered it, and that was enough. The goal isn't to catch every move. The goal is to execute your edge consistently and protect the profits the market offers. And that's the complete breakdown of this trade. We saw the major and minor inducement sweeps, the demand zone reaction, the bullish displacement, the fair value gap entry, the 1 to 3 target being achieved, and finally, the market reversal before reaching buy-side liquidity. The biggest takeaway is to trust your process and follow your plan, not your emotions. If you want another detailed breakdown of a smart money concept like this one, let me know in the comments. Comment "breakdown" below, and don't forget to like, subscribe, and I'll see you in the next video.